Today we're talking about investing in real estate. I'm Luisa Cruz and I'm with Prosperity Real Estate of Keller Williams Princeton. So a lot of times I get a call from a client that wants to start investing in real estate and they tell me, please guide me, you tell me what to do, I want to invest in real estate. And I always ask them, what's the goal? And a lot of times they look at me like, what do you mean to make money? And although I love that answer, there's so much more that goes into investing in real estate. So let's just get into it. First of all, why invest in real estate? Most people invest in real estate because they want passive income. And it's possible to do that with some kind of real estate investments, but not with all real estate investments. When you invest in real estate, there's certain tax benefits you can take, which is one of the reasons why people go this route. You can sometimes deduct expenses that you use to make the property presentable, habitable, and updates that you do to the property as well, differently than what you can deduct from the primary home that you live in. Another reason to invest in real estate is diversification. And lastly, people invest in real estate to build equity. And that is something that takes time. We'll talk more about that a little bit later. But when I ask you, what is your goal? Mainly, I want to know, are you doing this for passive income? Are you doing this for immediate money? Or are you doing this for the long game? And there may be different properties that you're doing for different reasons. There might be a great deal that you found on a house that you can flip and that you can make quick money on. And there might be a property that you know is in a good rental market. It may not be the cheapest home, but you know that that area is going to continue to increase in value. So that is a good strategy to invest in that property for the long-term goal. So you're going to have a tenant live in that property, pay off your mortgage every single month, and you're getting the property appreciation every year too. So if you hold that property for 10, 20 years, you will be maximizing the amount of money that you're getting from that home, even more so than when you flip a property. So that's a really important item that you need to think about when you're thinking about your real estate investing strategy, is whether you're trying to do it for the long game or you're trying to do it for the short game. And that's going to really help me and anybody that you work with to find the right property to fit that criteria. If you're looking for money in the next month, investing in this type of real estate investment might not be for you. There's so many different kinds of real estate investments. You could do wholesaling, which is when you put a contract on a property for a certain price and you're able to sell that contract for more than what you have it under contract for, and you can make that difference. So a lot of times you could do this in an appreciating market, like we were last couple of years, where the homes were going up in value $5,000, $10,000 per month. You can put a contract in on a property for, say, $200,000. You know that the property, after it's been updated, is worth $400,000. So you can essentially sell that contract on that property for, like, let's say $250,000. You find an investor that's going to flip it for another $50,000, and they can still make $100,000, and you made $50,000 before it even closes. So the closing happens all at once. The seller gets their money, you get your money, and the end buyer gets their property. Another thing is, if you're really hands off and you don't want to have an asset that you're looking after, you have to really think if this is a right avenue for you. Because real estate investments, for the most part, does take time and effort. You have to maintain the property, the yard, the home maintenance that happens every year. And especially when somebody lives in your home and it's not you that are living there, they're not going to take as good care of the property as you would when you live in your primary home. So just keep in mind that you're going to have to do like quarterly check-ins, make sure that all the appliances are clean, that the filters are changed and all of the major appliances, that things like that are happening so that you don't get, a big shock at the end. And if you're not a hands-on person, keep in mind that you're probably going to have to pay someone to be that hands-on person that's going to be looking at your property every single month, collecting the rent, making sure that the property is up to par so it doesn't decrease in value. So what makes a good investment? Like we said, your objective is really what is going to make a property a good investment. And I want you to understand that a good investment for me may not be a good investment for you. There are so many different strategies. I had a client at one time that purchased all of her properties cash. And what she did was she bought the first one cash, then she got a second equity line of credit on that one to get the cash out to buy her second property, and so on and so forth. So she had all of these assets basically snowballing from the first asset. I also knew someone that would take out a mortgage for every single one of her properties. She would look for new construction property so that there wouldn't be that much maintenance to put in the property. The automatic gain that she would be getting every month is not that much. However, she's banking on the appreciation of that asset over time. So it really depends on what it is that you're looking for and what your goals are. If you're looking to maybe quit your primary job and you want passive income, then you're going to want to get a property that's going to be able to give you a substantial amount of passive income, or have numerous properties that are going to give you passive income every month so that you can use that money to not only save to do the maintenance for that property, but also to pay for your daily expenses. And that gets me down to the numbers. When you're looking at an investment type, you have to figure out what numbers work for you. And there is no right answer here. A lot of people have heard that there's a 1% rule, and they're very strict on whether the investment doesn't produce the 1% rule. The 1% rule is that if you purchase a property, let's say for $130,000, you have to get at least $1,300 in rent every month in order for that asset to be a profitable one. Depending on where they're looking, that may not be possible. If you're looking at an area that has a good, stable rental market and appreciates in value consistently, you're probably not going to find that 1% rule unless you're going to do a lot of work to that property. So if you're looking to go into a property and just paint it and get a renter in there, getting the 1% is going to be really, really difficult. That doesn't mean that it's a bad investment, because remember what we talked about. You may not be getting a huge amount of money every single month, but if you know for certain that it's in a good area, good school district, and is in high demand, that asset is going to continue to increase in value. So you're going to get your gain on that piece of it and not just on the passive income monthly. My husband and I went to a resort recently, and they were actually selling the units that we stayed in. So we took a look at a couple of them, and we were working the numbers to see if they were a good investment for us. When they gave us the previous calculations from the previous owners, we noticed that the property was not rented out all year long. It was only rented out probably 20% of the time. So when we looked at the amount of money that they were asking for, all of the income that this property would be getting in throughout the year, and how much expenses we would be paying for, because we had to pay for the maintenance of the property, it just didn't make sense. Mind you, different people own every single unit in this property, so this was an investment type for some people. So here are a few key indicators that are going to help you understand when a professional will give you the numbers for the property, so you can understand this a little bit better. First, you're going to have the net cash flow. The net cash flow is the annual income of a property minus the annual operating expenses. The property we were just talking about, we were only going to get a $20,000 cash flow, and the expenses for the property was close to $12,000. So for us, that $8,000 net cash flow was not sufficient for us to tie up so much money in one property. The next key indicator is cash on cash returns. Take your net cash flow and divide it by your initial investment. The results will tell you your cash on cash returns. Next, we have the economic vacancy rate. The economic vacancy rate can be determined by multiplying the number of vacant units by 100 and then dividing that by the number of total units. This will help you measure your vacancy rate against similar properties in the area and can even signal when it's time to raise the rent. Property appreciation. Keep an eye on the property value of each of your investments and track the appreciation rates over time. This is a good indicator of the long-term holding benefits of the property. Now let's talk about financing options. A lot of people out there think, this is great. I would love to invest in real estate, but it's not in my grasp. And I want to tell you that yes, it is. There's so many ways that you could get started with this. The first way that I would recommend is that if this is your first home, use an FHA or some government-backed loan. The reason for that is that it's going to have a very low down payment because you're going to use it as your primary home. So buy the property, live in the property for a couple of years, and then rent it out. The loan for your primary home is usually the best rate that you can get in interest loans. So you're going to have a really decent interest rate. And depending on where you are, you may get more for rent than what you're paying for your mortgage. So that's your first investment. On your second investment, you could look into conventional financing. What I would suggest in this instance, you bought your first one with, let's say, an FHA loan. You lived there for 2 years. Now you're turning it over, you're renting it out. And your next home is also going to be your primary home because now you're leaving the FHA loan as a rental and you're moving up to your next primary home. Use a conventional loan there, which the options for down payment there could be 5, 10, or 20% down. You're again going to get a very good rate on your interest rate because it's going to be your primary home. Live in that property, maybe forever, or do it again. Switch this one to be an investment property, move on to your next primary home. Or you can take out equity loan of credit on your primary home and then use that money to purchase the rest of your investment properties. Another type of financing that you can use for these types of assets are hard money lenders. Hard money lenders are not regulated by the government, and because of that, they usually have a really high interest rate and a very short time to pay the mortgage back. So a lot of people that are looking to flip homes, if they don't have any cash on hand, this might be an option for them because they're thinking they're going to improve the property and sell it and get money back from it in less than a year so they can pay that hard money lender back and then get the excess proceeds as their profit or as reinvestment capital. Another way you could do it is by getting a partner and setting up some kind of a business partnership. Sometimes if you don't have a lot of money, you may be able to do this when you find someone that does have a lot of money, but you do maybe all the legwork, all the property management, all the maintenance on the property. You might find someone that is interested in purchasing a property but does not want to be shackled down by all of those different hassles. You can take on that part of the business while they do most of the capital. Another type of financing is seller financing. With this type of financing, basically the seller is going to give you a loan. You're going to pay the seller directly for the property. These loan terms will vary greatly depending on the agreement. Just make sure that the final contract is down in writing so that there is no confusion. Another way that you can finance your investment property is by a self-directed IRA account. Review the specific ins and outs of your account and make sure to follow any tax requirements. SBA loan. These loans are usually used for commercial properties, and there's different lending options available. You may be able to do this by purchasing a property under an LLC. Lastly, I want to talk about DSCR loan. This loan is usually a zero documentation loan, and it takes into account the rent income that is going to come to the property instead of your personal finances. How do you get started? So if you want to invest in real estate, let's have a conversation. Let's talk about what your goals are, how we're going to finance that dream, and what type of asset class you want to buy. And we can get started from there. Can't wait to help you. And thanks for joining in.